SOS. My friend made 60% returns in XYZ stock in a year.
Wow, that's huge.
I know, right? Some people are lucky. And look at me, stuck with ABC stock for 2 years. And it hasn't moved. Not even a bit.
Oh, but as much as I know, XYZ is a growth stock. These tend to give higher returns when markets are doing good. But ABC is a value stock. They usually take time to deliver returns. You can't expect them to deliver quick gains like growth stocks.
Oh, growth, value, that's confusing. Not an easy one for me.
Of course it is. Let's dig in. Growth stocks or value stocks, which ones are better? Which style of investing is suitable for you? What do all these terminologies mean? What all you need to know about them? Well, if you are also struggling with similar questions, you are at the right place. Hello and welcome to our channel 5 Minute Finance by ET Money, where we talk about the basics of personal finance. Today we are going to discuss in detail about the growth and value style of investing. We'll understand what they mean, how they are different from each other. So, by the end of this video, you will have clarity about which one of them is suitable for you. So let's begin. As the name suggests, growth stocks are referred to companies whose sales and profits are growing at a faster pace compared to other companies in the same sector. Growth here means earnings or profit growth of the company. So let's take a very simple example. Suppose the profits of the company in a sector are growing at 10%. But profit of one of the stocks is growing at 15% year on year, then that stock can be classified as growth stock. As a stock's price tends to follow earnings growth, such stocks are expected to deliver higher returns compared to their peers on the stock market. Now let me share some common traits that growth stocks have. Once you understand these characteristics, it will be easier for you to identify a growth stock. Okay. So growth stocks have a strong leadership. They are part of a growing industry which is expected to have a stronger demand going forward. These companies may be in the early or middle stages with scope of high growth in their businesses. They command a big market share. They may have a technological advantage over peers. They may also have a big target market. You won't find a company catering to a niche segment to fall under this category. Now, due to these traits, the stocks of these companies will be in high demand. So tell me, what do you think will happen if there is a huge demand for, say, a new edition of PlayStation or a limited series watch or mobile phone? People get ready to pay extra price for that product, right? Now, in the same way, as we discussed that the stocks of growth companies will be in high demand, people or investors will be ready to pay a higher price for that stock. Or I can say that investors will be ready to pay higher price for 1 rupee of earnings from that stock. This is what it means by high price to earnings or high PE ratio. PE ratio is calculated by dividing the stock price by the company's earning per share or EPS. Now EPS of a company means profit per share of that company. So PE ratio shows how much investors are willing to pay for a single rupee of earnings of that company. And growth stocks command higher PE ratios compared to peers as investors are willing to pay a premium. The price that investors are ready to pay for growth stocks are generally higher than the actual worth of that stock. But how will you know the worth of that stock? Well, the stock's intrinsic value or the book value tells you that. Intrinsic value or book value of a stock is calculated by subtracting the liabilities of a company from its assets. So suppose assets of a company are 500 and liabilities are 300, intrinsic value will be 500 minus 300, that is 200. Now, whether a stock is trading at a price higher or lower than book value can be figured out by dividing the stock price by the stock's book value. This is known as price to book value ratio or PB ratio. So growth stocks will have a higher PB ratio as compared to its peers. Now, as these companies are in great growth stage, they would want to use every money they earn from that business to be put back into the business to amplify the growth. They would refrain from distributing dividends to the investors at this stage. Dividend means that part of the profit which is distributed to investors or shareholders. So growth stocks will have a lower dividend yield ratio compared to peers. Look at the table on your screens. It shows the comparison of Bajaj Finance with its peers. But before we proceed, please note that any stocks mentioned in this video are not our recommendations. We have used them only as examples for explanation purposes. Coming back to the table. So if you see, Bajaj Finance has a higher PE and PB ratio compared to its peers, while its dividend yield is on the lower side. We can say Bajaj Finance as a growth stock. Growth stocks are generally highly volatile. They tend to rise and fall more as per the market conditions. The chart on your screen shows that really well. Hope you have understood the basics of growth stocks. Now let's move to value stocks. In simple terms, value investing or value stock refers to companies which are trading at a price lower than what that stock is worth. So you will see that value stocks generally have a lower PB ratio as compared to its peers. Value stock investing was originally derived by Benjamin Graham but has been popularized by the great investor Warren Buffett. It is like buying some good stocks at discounted prices. So in value investing, you look for stocks which have good fundamentals but are trading below their book value. It's like a bargain hunting. But remember, not any stock available at a discount is value stock. Strong fundamentals is an important criterion here. Understand it like this. So at times, if a stock price has been beaten down by some bad news for the sector or poor market sentiments, but it is a good stock with strong fundamentals, it is called a value stock. Unlike growth stocks, value stocks are steady players. They don't rise much or fall much. So major characteristic of a value stock is that the stock prices are beaten down due to some bad news or poor market sentiments, but the fundamentals remain strong. Value stocks will have lower PE as compared to their peers. Lower PE ratio tells you that the stock is cheaper as compared to its peers. Also, you may find that an undervalued stock is trading at a discount to its book value or intrinsic value. Plus, you may find that such stocks have a high dividend yield. So these companies know that their growth opportunities are limited. Thus, they distribute profits to their investors in the form of dividends. To look at an example of a value stock, let's look at the top holdings of value mutual funds. Now on your screen are the top 10 stocks where the value category of mutual funds have invested. Let's take Oil and Natural Gas Corporation ONGC from the list and compare it with its peers. So if you see, ONGC has comparatively lower price to earnings, lower price to book value and higher dividend yield ratio. It has traits of a value stock. But remember, you need to look at all the ratios in sync to identify a growth or a value stock. For instance, not all value stocks may have a high dividend yield and so on. Now coming to which category of investing strategy is the best for you, growth or value. Both type of stocks have their own benefits. Growth stocks tend to fall more during the market corrections, but at the same time have the potential to deliver higher than market returns during the bull phase. On the other hand, value stocks tend to be less volatile, but you may have to hold them longer to reap benefits. Therefore, we cannot pick out one out of the two as the winner. You should use a mix of both in your portfolio to get the best out of it. It will also help you diversify your portfolio. Also, remember, a stock that is value buy today may become a growth stock tomorrow or vice versa. For instance, HDFC Bank. It is a great example of a growth stock which is currently being looked at as a value buy by mutual fund managers. The stock is around 14% down year to date. So it requires constant effort and time, as you will need to track the companies regularly to take your pick. Or an alternative route could be investing in stocks via equity mutual funds. With this, we have come to the end of this video. Don't forget to like this video and subscribe to our channel. We'll come with another insightful video soon.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.